All right, Stephen Newland, welcome to Simple but Hard.
Thank you. I'm pumped to be here. I love the concept. So
Awesome, awesome. So, like I said in the message that I shared with you, um, I used to think that there was some secret shortcut to success, but the more that I have small amounts of success and the more successful people that I talk to, it's just about doing the simple things incredibly well, which turns out is really hard. So when I think of you, I found you on LinkedIn because you break down finance in a way that is really easy to understand. So today, let's just jump in. I think you got the three main financial statements ready to go through.
yeah, and I love to share a quick like just a quick story. I remember being in my first internship. I interned at Delta Airlines in college, and I remember like trying to explain this like financial thing to non-financial people, and I fumbled my way through it. I was so bad, and so I have made like so many mistakes in this area. So it's like forced me to, how can I simplify this? How can I like communicate this in a more simple way? So I've been on the other side of this. So
I love it. I love it.
yeah.
Well, real quick, to kind of frame how important this is, what happens when we don't understand finances, both in our personal lives and then in like a business too?
Yeah, it's such a good question. I'd say like from the business perspective, um, as you go higher up the ladder, like inevitably finance just becomes a bigger and bigger portion of what you'll be brought into. And the reality, because at the end of the day, like the investors or the shareholders or whoever owns the company, they care about the bottom line. And so that's why, the CEO ultimately, like they're thinking about how much cash do we have? Do I have enough, in the bank? Are we and so that's why it's so critical on the business side. You don't have to know all the accounting and all the, ins and outs. But just knowing like even a fraction of it in any role is critical, I think, to success in the business world.
Yeah. Well, man, that's so good. A quick note on that. I saw, I think it was MJ Peters, who is a marketing voice on LinkedIn. She was saying that she found in every like monthly report and quarterly report that the people who put the numbers in the report were in the report every time. And she
Mm,
was like, that's interesting. Maybe if I understand the numbers more, I'll advance more in my career.
very
So,
interesting. That's a good insight.
so with that being said, take
Yeah.
us away. What are the three main financial documents that any business has?
Yeah, so there's three. The first one is the profit and loss statement, or you'll hear it called the income statement or the P&L. That's what all the cool kids call it, the P&L. The balance sheet is the second one, and then the cash flow statement. The kind of an overarching thing over all three of those, you might have heard the terms cash basis or accrual basis, and those can be kind of confusing for people. But this kind of dictates a lot about the financial statements. So cash basis is essentially meaning, and your books can be kept in one or the other. So cash basis essentially is, when did the money come in and when did the money go out? And so if you see a P&L statement or an income statement that has cash is cash basis, it's just measuring when did the money come and when did it come in and when did it go out. But many businesses actually operate on accrual basis, and essentially all accrual basis is measuring is, when did you earn something and when did I use something. And this can be like a very confusing concept for people, because we kind of think, oh, I'm seeing, we just think like, oh, it's just cash. It's just like when the cash comes in, but when it goes out. Um, and I have a good example, I think, of this. Think about, like, if you have you ever had to pay for a subscription like annual upfront?
Mhm.
So if you were on, if let's kind of think of this from the personal standpoint. If you had your books on cash basis, it would show that you had an expense of, let's call it $150 in month one, for your Netflix or whatever it was. But in reality, if you were operating on what businesses use an accrual basis, you would only actually see about 1/12 of that expense on your income statement. And so this can be kind of a confusing concept. And so if you can kind of grasp this concept, it can make the financials a lot easier to understand. So that's kind of the first, that's where it can get a little bit confusing, but that's kind of the first key piece of the profit and loss statement.
Okay, so the P&L manages what comes in and what goes out.
Mhm.
And then there's two, what would you call them? Like categories of P&L, or how would you describe that?
Yeah, I would say, yeah, that's a good way to put it. Your business either operates on one or the other.
On one or the other, and it's either
Yeah,
a cash basis or an accrual basis.
that's right.
Okay. And it
Eh,
sounds like accrual is more popular.
Yeah, I would say a lot of like small businesses might do cash basis just because you don't need to like all these fancy accounting. You just don't need to do a lot of accounting. It's just bank transactions. It's like how we would do our personal life. When
Mhm.
did the money come in? When did it go out? That's all we really care about in our personal finances. But for a business, I guess the way to think about it is if I can understand how much I'm actually making in a period, and then how much am I actually using in terms of expenses for that same period, it actually helps me evaluate how my business is doing a lot better than if I just measured the cash in, cash out.
Interesting.
Yeah.
Okay. Very cool. Okay, so that's P&L.
That's the
Anything else on
P&L.
P&L?
That's about it. It's just the goal is to understand how much you made or spent in a certain period. That's essentially what the P&L is for.
Okay. All right. That makes sense. That makes
Yeah.
sense.
And then the next one is the balance sheet. And this is where it can get even more confusing. Um, all this simply is essentially it's three components. It's assets, it's liabilities, and it's equity. And another way to kind of reframe each of these assets are just, what do you own? You know, this is like the cash in your checking account. I'm going to use all this like on a personal basis. This is the cash in your checking account. This might be the furniture that you have in your house. It could be, you know, that $10 you have on that Starbucks gift card. These are all assets that we would own. A liabilities is, what do I owe to others? So, you know, I have that $2,000 balance on my credit card. I have my car note. You know, I might have a mortgage. These are all liabilities, things that I owe somebody else. And then the equity is just the net worth. It's essentially just what's the difference between what do I own and what do I owe others? And that's going to be my net worth. So that's the best way to think about a balance sheet.
Interesting. So equity is also, so in personal finance, it's net worth.
Yeah.
Business finance is equity.
Yes, that's right.
Okay. Interesting.
But it's essentially measuring the same thing.
Got it.
Yeah.
Okay. So here's another this, and this may be totally off topic, but when people talk about taking equity in a company, that's
Mhm.
different, correct?
Yeah, it's it's essentially like owning a piece of the, yeah, you would be have a right to own a piece of the company.
Got it.
Um,
And really what it be is you would have a right to own, like you would get equity in the equity. Is
yes,
that
that's a good, you have ownership claim to if you get 1% of shares, you would have a 1% claim to that equity, to that net worth section.
interesting? So
Yeah.
if the equity was negative
Mhm.
um, on the balance statement, and you
Yeah.
had, say, let's just say 10% of shares,
Yeah.
would you then inherit 10% of the negative?
Not in the business world, but in a if you think about it in the personal finance world, let's say you have a big student loan, then yeah, you've got that equity, that negative equity is one way to put it, or that negative net worth. But in a business sense, that's when a lot of people, and even personal, that's when a lot of people declare bankruptcy, and it kind of wipes that out to zero.
Interesting.
Yeah.
Okay. I'd love to hear more about what happens when someone declares bankruptcy, but let's go
Yeah.
to the third one, the cash flow statement you said.
That's right. Yeah.
Okay.
So this one, believe it or not, this actually confuses a lot of finance people. This is like the finance people don't want to say this, but this is the one that confuses most finance people. But all it simply is just a pure measure of how much money came in and how much money left this month. That's essentially all it's going to show you. And so remember how I was talking about cash basis P&L before? If you're on cash basis, your P&L and your cash flow statement are going to be, I want to caveat it, but for the most part, it should be identical. It's just the cash coming in, the cash going out of the business or your personal life. So yeah.
Okay. So why does that get so confusing for finance people if it seems like it's a simple thing? Is it because of the
Yeah.
accrual system?
That's exactly right. So the best way to think about the cash flow statement is you're unraveling all these accounting tricks and things that you're not tricks, but you're unraveling all these accounting things that you've done on the P&L to get to, okay, what was that cash in, cash out? But you have to like unravel all these different accounting entries and accounting concepts to get there. So that's where it can get a little confusing to at least explain it to somebody who's not used to it.
Wow. Very cool. Very
Yeah.
cool. Okay. Last question here. If someone does go bankrupt,
Mhm.
what happens to that?
Yeah, it's a really good question. There's a lot of different kind of at a high level. What would happen is your whatever you have in your assets. So the hypothetical case would be, let's say I have $50 in assets. I have $50 in cash, but I owe $100 to somebody else. So I have $100 of liabilities, and now I have -50 in equity. So what happens is my 50 of assets in cash, I go to pay off the first $50 of my liabilities. Okay, but now I have zero cash. I have nothing left over, and I still owe somebody $50. So where does that go? What happens is that liability just gets zeroed out. So it goes to zero. And so it's essentially all three now, your assets, your equity, or your liabilities and your equity, now all of a sudden just get hit refreshed and they go to zero. So that's essentially what happens. And somebody on the other side of that, if I loaned you that $50, I would be the one that essentially would have to lose that $50 because you or somebody declared bankruptcy. So someone loses out in the end. Yeah.
Interesting. Interesting. Well, Stephen,
Yeah.
thank you for breaking that down. That makes
Yeah.
so much sense. Where can people find you?
Yeah, I'm always on LinkedIn. So Steven Newland on LinkedIn, and I'd love to connect there.
Awesome. Well, thank you so much, my friend. This was
Yeah.
amazing. I felt like I learned a lot more about finance than I did in college. So
Nice. I'll take it.
hey, I'm going to stop this thing.